Welcome to today's webinar on agricultural credit conditions. I'm Haley Shenander with the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of this presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'm going to turn it over to Joe.
All right. Thank you, Haley, for that introduction. And thanks to all of you in the audience today. It looks like we have a good number of people joining us, so happy to see that. For those of you who haven't attended one of my presentations of this nature before, this is going to be based on the results of a quarterly survey of agricultural credit conditions that we do. I'll talk a little bit more about that survey and what it is and what it isn't. But it's also kind of a broader look, even though it's a survey of bankers, it's a broader look at conditions in the agriculture sector more generally. And while we do the survey on a quarterly basis, and it is released on our website on a quarterly basis, and you can find previous releases on our website at minneapolisfed.org. Today's release will be shared later in the chat. We really think it's often very interesting to highlight the surveys that we release in the spring and in the fall. So those are the first quarter and the third quarter results of this survey, because they're really coming in at a time where right now we're going into spring planting, and so we're kind of getting ready for the peak of the growing season right ahead. And then in the fall, we'll often do a survey at harvest time is a good time to kind of check in. So we usually do these webinars twice a year. So that's a little bit of background on this survey. That's what I'll be talking about. Before I go any further, just want to give my standard disclaimer that my views are my own, not necessarily those of the Federal Reserve Bank of Minneapolis. I won't be probably preferring too many opinions this morning, or at least I'll try not to. I will share the results of our survey, which is in a sense kind of an opinion survey, but I'll be kind of indirectly preferring opinions of others that we survey. And this is a survey is like I said, a good way of gathering information about a very important industry in our region in the Ninth Federal Reserve District, and that's agriculture. So I'm going to start by giving kind of just a brief overview of kind of what is the size of agriculture in the Ninth Federal Reserve District before I get into the results of our survey itself, just to kind of give you the headline takeaways from today. We're at about we in the first quarter found continued decline in incomes. We're on now about 2 years of falling incomes per this survey. That's also consistent with some of the data that we have from the USDA that I'll show you in a moment. One of the things we ask about in the survey are agricultural land values. So even though farm incomes have been falling and relatively weak over the last couple of years, land values are holding up pretty well. However, cash rental rates for farmland are down, and that's kind of a new result in this quarter's survey. So you'll see what that looks like toward the end of my talk. And then I have a little bit of forward-looking information from the survey. We ask survey respondents what they're expecting to happen over the next 3 months. And maybe unsurprisingly, given everything that's been going on in agriculture and the current levels of crop prices, the outlook for the spring is rather pessimistic, at least in terms of the expectations for farm income. So that's kind of the headline detail. Just a quick refresher for anybody who's attended one of these webinars before, or just a level set in case you haven't attended one of our webinars. The region that we're going to be focusing on is the Ninth Federal Reserve District. So the Minneapolis Fed covers the states you see on this map right here: Minnesota, North Dakota, South Dakota, Montana, and then we have the northwest portion of Wisconsin and the upper peninsula of Michigan. Obviously, agriculture is a very important industry in our region. One thing that I should mention is that even though most of these states have pretty strong agricultural sectors, Michigan does as well. However, the upper peninsula of Michigan, there's not as much agriculture in that survey, and we don't have as many banks that are concentrated in agriculture there. So really the survey results exclude the upper peninsula of Michigan. There's a good amount of agricultural activity in our portion of Wisconsin, though, so it doesn't include results from respondents in that portion of Wisconsin. So like I said, you can think about this part of the country, and you think about the great amount of corn, soybeans, and wheat that are grown, as well as a lot of livestock production, obviously a lot of hog and turkey production in Minnesota, cattle ranching in Montana and South Dakota as well, and pretty diversified agricultural portfolio in our region. Before I go any further, just I want to mention Haley did drop a link in the chat for our upcoming our next webinar, which is going to be about construction. My colleague Eric Garcia Luna and Haley will be hosting this webinar, and that's going to be toward the end of the month. So keep your eyes tuned for that if you want to know what's going on in the construction industry. So a little bit of background more on agriculture. This is just the sort of a pie chart of where our GDP is produced in the U.S. and then in some of the states in the Ninth Federal Reserve District. And I've broken out agriculture as sort of the pie slice that's sticking out. You can see nationally agriculture, and then also we're including forestry, fishing, and hunting, relatively small part of overall GDP, much larger share of GDP in the Ninth District. It's actually a little bit misleading to say that it's just that agriculture is just 3.5% of our GDP in our region, because the way that we're measuring GDP, the way that we're measuring agriculture in GDP when the Bureau of Economic Analysis, the Department of Commerce compiles those statistics, is really they're just looking at value added in production agriculture. So the actual production of crops, livestock, dairy, and other agricultural outputs and what they account for as a share of GDP. It's not including all of the transportation, all of the inputs going into agriculture, as well as the processing and manufacturing of food and other intermediary products that are coming out of agriculture as well. And once you were to take account for some of that activity, it would be a much larger share of our GDP. But what I want you to get from this chart, though, is just to see that compared to the U.S., even that small segment of what we might broadly consider agriculture is a much larger portion of our regional economy. And in fact, when you start to get to individual states like North Dakota, it's an even larger share of the economy in North Dakota and South Dakota, for example. So pretty important industry in our region, even if you just look at it that way. Another way of looking at it is just to look at what's the value of commodities that are produced in this region. And this is in billions of dollars terms. This is all in adjusted for inflation. So in 2025 dollars through 2023, you can see that we're producing more than $70 billion, or we're producing $70 billion, more than $70 billion worth of agricultural commodities in 2023. One thing that I want to show you here, just sort of over time, you can see the last couple of up cycles and downturns in agriculture when you look at this. So we had a big boom in agricultural production, or rather the value of agricultural production in the early 2010s, the late 2000s and early 2010s, we saw a surge in the value of agricultural production. And then one more recently, right around 2020, just after the COVID pandemic, we saw the most recent sort of run up in agricultural production. And you'll see that also when I show you what agricultural incomes look like over time in a chart that I'll pull up in a minute. But one thing that I want to sort of preview to you, this only goes through 2023 because we only have these data available for states through 2023, but you can see that dip in cash marketing from agricultural commodities in 2023. And that's because that's when we started to see the prices of a lot of these, the market prices of a lot of these core commodities start to turn downward. So we started to see incomes along with that start falling in about 2022, 2023, and that's borne out in the data from our survey as well. So it's been going on for a couple of years now, and I anticipate that when these data come out for 2024, you'll see a further downturn in the value of what's sold by agricultural producers in our region. So that's some kind of sort of macroeconomic background about the size of the industry and where it's been recently. Now to get into kind of the survey results, just a quick reminder. So the survey itself, I mentioned at the beginning, is a quarterly survey. We conduct it at the end of a quarter. So the most recent survey was for the months of January through March, and was conducted in April. It's backward looking. We say we ask these respondents what happened over the previous quarter, and then we ask them for their best guess or their expectations of what they think is going to happen over the coming quarter. And again, as I mentioned earlier, this is actually a poll of banks in our region that are concentrated in agriculture. And just to be clear, so it's not a random sample. In fact, these are Federal Reserve member banks, so they're not certainly not all of the community or agriculturally concentrated banks in our region. But we check in with them on a quarterly basis, so we're getting a good, consistent set of kind of opinions and views on what's happening in agriculture. Had a little bit of a lower turnout in our April survey. I'm not exactly sure why. Only 46 bankers responded, which is not really, really low. It's usually up towards in the 50s or 60s, so a little bit lower turnout, but again, pretty broad representation from across the region. And again, I want you to think of this as being sort of like an expert panel. Where we're asking bankers who do a lot of lending to agricultural customers what's happening with their customers, what they see happening with their customers' incomes and financial condition, and then, of course, what's happening with some banking indicators like lending, and you'll see what those results look like in a minute. So it's just a good way of checking in on the sector on a more regular basis. As I mentioned earlier, the kind of headline results from the first quarter survey, again conducted in April, heading into planting season. We're seeing a decrease in farm incomes on a year-over-year basis. Not to overinterpret a little bit of positive news, but we did see a slight uptick in the share of respondents telling us that incomes actually went up, but overall, overwhelmingly, incomes went down compared to a year earlier, according to most of the people, the vast majority of the people we surveyed. Capital spending, that is investment in equipment, in buildings, and other capital assets by farm households, is also dramatically down. Household spending, that is, purchases of consumer items by farm households, actually up slightly on balance, which is going to kind of continued sort of good bit of news for rural communities that are heavily dependent on spending by farm operations, even if they're not in the farming business themselves. You have a lot of main streets, obviously, that rely on farmers spending and other agricultural producers to spend to keep those businesses afloat. So still positive growth in household spending, even though incomes were down. We also saw some relief on the interest rate front. That's been ongoing for the last year or so, that we've seen a downward movement in interest rates. They're still pretty high overall compared to where they were prior to about 2022 in the latest sort of interest rate tightening cycle. Even though interest rates are high, still pretty strong demand for loans, and that's consistent with less cash on hand, need to borrow more to continue financing ongoing operations, and a downward movement in the rates of repayment on those loans. That's not necessarily a sign of distress, but just early repayment and things like that are down. And then I mentioned land values are up, cash rents are down, and then a pessimistic outlook for 2025. So what does that actually look like in detail? Well, one of the core things that we ask about is farm income. I think that's probably maybe the most relevant indicator that we ask about in the survey. What are farm households actually earning? And as you can see, and we ask about this on a year-over-year basis. Obviously, agriculture is a heavily seasonal industry, so you want to when you're asking in April what happened with farm incomes, you don't necessarily want to compare to what was going on at the end of the year at harvest time when a lot of product was getting marketed. You want to ask how it compares to a year ago, a relatively comparable period. And so 80% of the lenders that we surveyed told us that farm incomes were down on a year-over-year basis. And that's coming off of a lengthy period of, a somewhat lengthy period, at least, of decreased incomes. So you'll see what that looks like over time in a minute. As I mentioned earlier, household spending held up a little bit better. Most of the lenders we surveyed told us that it was unchanged, nearly 60%, but just about a quarter told us that household spending by farm households actually increased. And then capital spending looking pretty similar to income. About 70% of the lenders that we surveyed told us that capital spending was down. I did get some comments that the market for used machinery and equipment is holding up pretty well, which I thought was interesting given what we're seeing in capital spending. But maybe we're seeing some substitution toward used machinery away from new machinery, perhaps, especially given the financing environment and the cost of new machinery. But overall, again, overwhelmingly decreasing in capital spending. So that's just one quarter of data compared to a year earlier. It's kind of interesting, I think, to look at how this changes over time. And you can see the chart that I showed you of cash income, or rather cash marketing receipts from agricultural commodities look pretty similar to this. That only went back to 2008, and I've got it here going back about 20 years, or rather more than 20 years, nearly 30 years, basically the whole history of while we've been doing this survey, which we started conducting in the mid 90s. So we're coming up on 30 years of conducting this survey, and you can kind of see those cycles in agriculture. The most recent one being in the early 2020s, the early part of this decade, when we had more than 90% of lenders telling us that they saw that incomes had increased or were holding steady on a year-over-year basis. So that's what this chart is showing you, just the share of lenders telling us that incomes were increased or steady. So you can think of it as basically being the inverse of those lenders telling us that that incomes decreased on a year-over-year basis. And again, I don't want to sort of overinterpret one quarter worth of data, but we did see a slight uptick in the most recent quarter, as you can see at the very end here in the share, telling us that income had increased. But I don't want you to read too much into that, because if you compare it to a couple of years ago, it's still overwhelmingly down, and in a sort of a diffusion index sense, it's down. And it's been decreasing for 2 years. So that's kind of where we are right now. Maybe we'll see some change in that, and that's again overwhelmingly related to the prices of agricultural commodities. One thing that I'll mention is that uh, we do see some more strength in the livestock side of the industry. Livestock, particularly cattle prices, but also hog and poultry prices, have been a little bit stronger recently. Cattle prices are at record highs, though, and so lenders in sort of more cattle concentrated areas are a bit more bullish. In fact, we got some comments from a number of lenders that operators who are diversified, who are in livestock as well as crop production, are doing a lot better. So not surprisingly, given that we've got kind of a more anemic picture for incomes, we're seeing greater demand for loans. So nearly 2/3 of lenders told us that they saw loan demand increase in the first quarter relative to a year earlier. Just over half told us that they saw a decrease in rates of repayment. Again, I don't want you to think of that necessarily as a sign of distress. But just to take that as a little bit less cash on hand. And then renewal activity, we kind of, for a lot of lenders that we surveyed, this was their season where they do a lot of renewals on operating and other loans. And you can see that about a third of them told us that renewals increased, compared to a very small share that told us that there was a decrease in renewals. So overall increase in loan demand and in loan renewal activity. Just to kind of get into what we're seeing in terms of the outlook next. So as I mentioned earlier, we asked the survey respondents what happened over the past quarter and what they expect to happen over the coming quarter. And it's basically more of the same. So 70% of them are expecting a decrease in income over the second quarter of 2025. Got a number of comments that that outlook is really based on expectations. The current conditions for market prices for crops, in particular agricultural commodities more generally, are still pretty weak and below break even for a lot of producers, even though there had been some uptick in corn and some other prices recently. Those are still at pretty low compared to their levels when incomes were really strong a couple of years ago. Household spending pretty much flat. Overall, you can see the breakdown is equal share of lenders expecting decreases and increases, and that's maybe kind of a continued sign of these incomes starting to really bind on a lot of houses. Again, got a lot of comments that farm borrowers have gotten through their cushions of cash or working capital, and that's increasing. That's putting more financial stress on farm household. And again, more than 2/3 expecting further decline in capital spending as well over the coming quarter. And then again, kind of more of the same on the financial condition side. 2/3 of lenders expecting an increase in loan demand over the coming quarter, and just about the same percentage expecting repayment rates to decline over the next 3 months, or rather the quarter that we're in right now. So we'll see what that ends up looking like when we release our next survey, which we're going to release in after the end of the second quarter in early August is when we're going to release our second quarter results. And that'll be a good time to check in because we'll be right at sort of the peak of the summer. Like I mentioned earlier, sort of one slight bit of good news that we had in this, or at least a little bit of relief, you could think of it as, for farm borrowers, is some continued downward movement in interest rates. Again, if you want to see more detail on this, you can read the article, which has just been released this morning. But you can kind of see operating both fixed and variable rates for operating and machinery loans have ticked down over the last couple of quarters, and they actually came down, most of them are around 20 basis points, or 0.2%, over the last quarter. And so even though you can see they're still quite a bit higher than they were in early 2022, so they're higher than they were 3 years ago, but they've been ticking down recently, and that's kind of consistent with some easing in credit conditions more broadly. So that's sort of one bit of good sign that interest expense to continue financing operations is loosening a little bit. Maybe not surprisingly, one of the sort of special questions that we asked this time, we asked about changes in farm borrower liquidity. Maybe not surprising that the strong majority of lenders that we surveyed said that liquidity, that is cash on hand for their borrowers, for their clients, was down in the last 3 months, and only a small portion of them expecting it to increase in the coming 3 months. So you can see about 4% of them think farm borrower liquidity is going to improve or increase in the next 3 months. 83% think it's going to there's going to be less cash on hand 3 months from now, and a slightly larger share expecting it to basically be unchanged. So maybe some bit of relief for some lenders that we surveyed, but overwhelmingly declining farm borrower liquidity, and that's what you would expect to see after a period of a couple of years where incomes are down. That's going to start to eat into your cash on hand and eat away at liquidity. One last thing I'll talk about before we get into Q&A is just the land values picture. This is, as I mentioned earlier, a little bit, you might think of it as being surprising given that we're on sort of 2 years of falling farm incomes right now. You know, we're still seeing, on average across the region, farmland values go up. And I'm showing you here just state by state, and then for the district as a whole, what we're seeing, and the price of an acre of good quality non-irrigated farmland. So just comparing to a year ago. And this is only comparing, by the way, responses from lenders who responded in both periods. So we get an apples to apples comparison, making sure that we don't have in one quarter people responding from an area where land prices are higher, and that's skewing things. So just looking at the lender by lender responses, you can see that they're up almost 5% for the 9th district as a whole. And it's 3% in Minnesota, a little bit higher in South Dakota, higher still in North Dakota. I don't want you, by the way, you're probably looking at the periphery of the map and seeing a big 13% decrease in Montana and a big 27% increase in Wisconsin. I have to caution that even though I'm providing those numbers just for the sake of interest, that we get a much smaller number of respondents from those states. So there's only a few respondents in Montana who answered this question and answered it in both quarters, so that we can get that year-over-year comparison. So don't read too much into that. And then ranch land in Montana is looking at a different picture. Again, you can read the article, has a little bit more information. We also ask about irrigated land and ranch land. Those values are also up as well, and you can find that detail in the article. So overall, land values continue to be strong, maybe a sign of underlying confidence in the long-term prospects of agriculture in the district, even though currently commodity prices are a little bit weaker and harder to support incomes right now. And the last thing I'll point to is cash rents, which we're seeing a little bit more responsive. They tend to respond a little bit more quickly. So if you're unfamiliar with the market, farm operators can rent land from other owners who are adjacent to them who aren't farming on that land. They enter into rental contracts and they produce on that land, and obviously they get to market what they produce on the land. And what we're seeing right now is that non-irrigated farmland cash rental rates are down on a year-over-year basis. Again, maybe not surprisingly, given what we know is happening with crop prices and farm incomes. And again, you can see that's generally holding true across the district. So that's kind of where we are with the survey results overall. Not very optimistic news, not and a somewhat pessimistic outlook for the near term, but some signs of conditions at least kind of stabilizing or improving slightly. I don't want to overinterpret that, but I tend to look for the positive. So that's what we have. And with the few minutes that we have remaining to us, we can take some questions. Haley, were there any questions in the chat?
Yeah, as a reminder to everyone, if you have questions, please type them in the chat box on Zoom. We did have this one asking about, are these negative results a reflection of the expected impacts of tariffs on agriculture? And did bankers have anything to say about that?
So that's a really good question. That's obviously what's on everyone's mind right now. It's very much the kind of forefront of economic news right now is the sort of impending trade conflict that's been sort of simmering in the background. I will say that I wouldn't read these results of this survey as being too directly related to that. We did get a couple comments from lenders about tariffs. I'll get into that in just a second. But just to say, this survey was just asking about what happened over the last quarter. And as I've sort of been reiterating throughout this presentation, we've seen farm incomes declining for the last couple of years. So I wouldn't look at what's happened over the last quarter as being in some way any dramatic departure from the trend that we've seen over the last couple of years. And I wouldn't overinterpret that negative news as being really due to tariffs. Now, that being said, agriculture is a global industry. Producers in our region need access to international markets to get their crops, in particular, and other outputs to market. And so they're very much dependent on trade to support their incomes. And so we did get a few comments indicating that depending on how things go with tariffs and access to international markets, that could have further negative impact on domestic commodity prices in the United States, and that would be bad news for farmers. So a few comments to that effect, but I wouldn't overinterpret that. Now, more broadly, I do want to take this opportunity for those of you who are in the audience and are interested in what others at the Federal Reserve might have to say about this issue. The president of the Minneapolis Fed, Neil Kashkari, recently published an essay about tariffs and what are the potential implications for monetary policy. And then we also just recently released a Q&A with our research director, Andrea Raffo, who's an expert on international economics, about the impact of trade uncertainty. That is to say, even though we're not exactly sure what tariff levels are going to be right now, what is the impact that uncertainty might be having more generally on business activity? I think Haley's going to drop the links to those two articles in the chat. I would love it if you're interested in this topic. There's a lot more to be said about that, and I would take a look at those two things.
Great. Thanks, Joe. It looks like we have time for about one more question. Someone was wondering, how is spring planting going? Are there any concerns about severe weather this year?
So there were some comments about concerns about weather. So people who've been paying attention to weather conditions might know that we had pretty bad drought conditions in part of the district last year, particularly in western South Dakota and in the sort of certain wheat producing regions of Montana, the Golden Triangle, if you're familiar with that area. Right now, it looks like it's a little too early to say what the impact is going to be this year. In the eastern part of the district, we're having decent moisture right now, and some of our indicators from the USDA of crop planting progress are pretty good right now. So it seems like in a lot of particularly in the corn and soybean producing eastern parts of our district, where they're really sensitive to the weather this time of year, they're kind of right in the sweet spot where they want to have enough moisture to help crops grow, but not so much that it makes it hard to plant. And a lot of our district is kind of right there. Now, that I'm saying that based on information that we have from the USDA, not from this survey. The survey itself, which was conducted earlier in the spring, we did hear a lot of concerns from lenders about weather conditions and that being kind of a big wild card for this year. So we'll see what happens, of course, over the course of the growing season.
Great. And it looks like that's all we have time for today. So thank you all so much for joining us. More information will be in our follow-up email to this event. And please join us for our next virtual event, Regional Economic Conditions Construction Sector Outlook, on Wednesday, May 28th at 9 a.m. And with that, I hope everyone has a really great day.
Thank you.